How are commodity traders planning to address some of these changing market needs so that the EV drivers, etc., can power that? And I guess another question, how are governments and ECA supporting these supply chains, securing supplies?
And he'd been banked for 8 years, and then suddenly he sort of disappeared with about $111 million worth of stuff. So he'd gone to totally unsecured lending.
Hello and welcome to Trade Finance Talks. My name's Tapesh Patel, editor at Trade Finance Global.
My name's Jonathan Bell, editor-in-chief at TXF, with the parent company being Exile.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG. Welcome to the show, and today we're actually celebrating something quite special, the 10th anniversary of TXF reporting on commodity finance. I'm going to rewind back to 2014, and it seems like that was quite a long time ago and the world was very different. China has grown substantially during this period. In 2014, Chinese GDP was $10.5 trillion, and in 2023, it's reached $17.5 trillion US dollars, signifying something like a 67% increase. What else happened in 2014? The UK was still 2 years away from voting to leave the European Union. On a cultural note, TikTok was just an idea. It wasn't even launched until 2016. Now, while there are differences economically and socially, in reality, historic events tend to have a tendency to repeat themselves. In 2014, Russia invaded and annexed Crimea, sparking deep international concern for the security of the entire country. A few months later, in 2014, Israel and Palestine engaged in a 7-week-long conflict as the US and Egypt pushed for a ceasefire. I guess what I'm wanting to highlight is that the world looks different, but it also very much looks the same. I think the same can be said about commodity finance. While some circumstances may have changed, many of the problems we face have similarities to those 10 years ago. So it's such a pleasure to welcome Jonathan Bell, editor-in-chief and director at TXF and Exile Group, as we celebrate TXF 10 years in the industry. So Jonathan, welcome to Trade Finance Talks. And to start off with, I'd like you to introduce yourself, although I don't think you need much of an introduction. Who are you, where are you from, and what do you do?
Well, thank you very much, Deepesh. And as I mentioned, it's great to be here with you, and it's a great collaboration with Trade Finance Global and TXF on this, what will actually be the 10th Global Commodity Finance in Amsterdam. We are actually in the 11th year of TXF because we started up in 2013, but we didn't do a Global Commodity Conference in that year. The first conference that we did do was at the Beurs van Berlage in Amsterdam, which is the old commodity exchange, as you know. And it was far different to the one that we're running today, which we'll have many more people than we did back then. It's a real landmark for us, and we're really pleased that we've engaged consistently well with the global commodity finance community. And I think this conference that we're going to have this time round is really special. I think there'll be a lot of people wanting to come along because the night before the conference begins, we have a black tie dinner, which we've traditionally had anyway, where we present the TXF Commodity Finance Deals of the Year. But this year, I think we've got a few more awards to give out, which will be very industry related, and there'll be some very special people there. So it's a really good occasion for people to let their hair down. The night before the conference, it gives a real setting for the conference itself, where we anticipate that over the course of the conference we'll have about 350 to 400 people, and probably something from all walks of the commodity community. And a very good sort of discussion will take place, but also fantastic opportunities for networking and deal making. And we make a lot of time for that in the conference. And I think TXF has sort of exemplified how conferences can be done differently and in a more exciting mode than some of the others which have been sort of traditionally out there. It's not to say that we're flippant about anything. Serious business is done and serious discussions take place, and we have fantastic presenters and presentations and good debates. So very much looking forward to it.
Thank you very much, Jonathan. And look, we're delighted to be media partners of the Global Commodity Finance Conference, 22nd to the 23rd of May. Lots and lots to expect. I think something like 400 plus people are expected to attend over the 3 days. Producers, traders, bankers, financiers, law firms, insurers, and many, many others. So we're really looking forward to that. Now, I really want us to explore some of the key trends in commodity trade finance. I want to ask you more of a personal question, which is why commodities? Why are you personally so interested in commodities? And can you talk us a bit about your background? Because I think there's some sheep farming involved, right?
Yeah, so I've got a bit of a dodgy past. I was financially independent for 5 years before going to university because of various circumstances. So I just worked and traveled, and most of that time was sort of abroad. During that period, one of the jobs I had was as a precious metals buyer in the United States, and that's mainly gold and silver. But I could only stand the States for a year, so I decided to disappear and go somewhere else. So I have also ended up in New Zealand as a sheep farmer, where I looked after 3,000 ewes for quite a long while. And I've got a very fond spot for New Zealand and for sheep, of course. And on the other side of commodities, I worked for the FAO, Food and Agricultural Organization, in Libya as a remote sensor, analyzing satellite data, satellite imagery, and then going out into the field and looking at agricultural implications, of various patterns that were being developed there, which was interesting because it was at the time of Gaddafi. But then, I got into a job where I was an economic researcher, but mainly on commodities, and that was really along the lines for compensation trade, counter trade, and barter and that kind of stuff. And then started up a newsletter which got bought out by Euromoney, and I ended up being with Euromoney, and eventually there from 1990. I worked there till 2013, sadly. And ended up as the editor in charge of Trade Finance magazine until starting TXF. TXF means Trade and Export Finance, of course. We're now exiled because that's our parent company, which we started up as well. And that's sort of the broad story of how I got around to it. So I've always had, commodities in my blood, and I really like that, even though I've always covered sort of export finance and project finance and various aspects of infrastructure finance. But I particularly like commodities because it's real business. I like metals and all that kind of stuff, and agri-products. It's got a little bit of meat to it for me.
I think we've gone full circle because I see you're wearing a 24-carat ring on your hand, and here we are in Hatton Garden, which is home of Trade Finance Global. It's actually historically home of many gold traders and still is. And I guess that brings us on to talking about the history of commodity finance, and perhaps let's talk about those 10-11 years since TXF has been reporting on commodities trade financing. How has it really changed over the past 10 years? Because I think at a high level, there's the obvious stuff, the banks exiting, the huge frauds that have been reported, the unreported frauds, and also that real shift in priority towards ESG, return on equity. What are the impacts of some of these big macro events over the past decade?
It's a big question, and I'm not too sure whether I can do it sort of total justice. The frauds thing is nothing new, within commodity finance. Even back in the late 90s, there were some quite weird frauds, that took place. If I just give you one little example, there was a trader in the Middle East, I think this is about 98, and he'd been banked for 8 years, and then suddenly he sort of disappeared with about $111 million worth of stuff because he'd gone to totally unsecured lending. The story goes that he just disappeared, this guy. All the agencies out there to look for this guy. You could even phone his mobile number sort of 6 months after this whole thing took place. And you could still hear him, but it was just him laughing on the phone. So the story goes. Anyway, moving on, there's always been things, but they get blown up. It has given commodity finance, even trade finance, commodity trade finance, a bad name, but it shouldn't have a bad name. Even if we go to 2014, and 2014, we had some really significant frauds that took place. The one Qingdao in China, Qingdao warehouse receipts fraud, which implicated so many banks, so many traders, and there's still cases going on today, legal cases, and along with Peng Lai, another warehouse frauds. And this is mostly on metals, but it was also some agri-products that were involved in this. That shook the banks. That really shook the banks. And as you know, there was, some significant impacts of that. A lot of financial losses, but also banks wanting to move back, exit from the business. So we saw quite a bit of that. And I don't know whether you want me to go into detail on that.
I guess who are the winners and the losers of this? Because I don't think it's fair to say commodity trade finance is an unprofitable, decreasing business, right?
Exactly, yeah.
The winners are the fraudsters, right?
Maybe. I mean, some people get away with it, some others don't, and that's the end of their business. They're not going to sort of create another chance of that. So if they've got away with it, then, they've got away with it. A lot of them haven't. They've gone to prison with the fraud in 2020 with Hin Leong in Singapore, but you see people that are in prison. So there's a lot of implications that are attached to that. The question, who are the winners and the losers? That's a really difficult one because, what do you describe as a winner and what do you describe as a loser in this whole maelstrom of commodity business? For me, the real losers are the banks that lost money, the traders that might have lost money, or those institutions that have spent months and months and months, paying out to lawyers to sort of like to go through court cases. That's just a waste of time for them, when they could be actually sort of like making money and going back to business. I guess they're losers in that sense. And I also think some of the banks that have exited might not think that they're the losers, but I think that they are because they missed an opportunity. So big banks that exited, say like ABN AMRO and BNP Paribas, they still retain some key clients that use commodity finance in some way. They've lost a big raft of potential new business, so they've lost out in that. But there is a chain of thought that even those banks will come back in, a bit more. And as we see commodity cycles go round, when we get to a super cycle and things, those banks will come back in at some juncture. It might be sort of 15 years from now. It might be 10 years. Who knows? Losers on that side. Losers, particularly, I feel, are the small traders because what happened to them and small producers, what happened to them is the cost of their finance just went up. It didn't. Most big traders will say the cost of their finance didn't necessarily go up. Well, we can take that with a pinch of salt. Certain things will have gone up. There'll certainly be more covenants in place, and we'll probably get on to sort of like talking about structured trade a bit later. But those are some of the losers. Winners are certainly the law firms because they've got sort of like tons of business. They could be there forevermore, on these sort of things. And it's expensive business going to litigation like this. Also, I actually think the whole of commodity finance is a winner. Because what has happened, it's shaken up commodity finance. It's a wake-up call. So various things have happened. One of the things that's happened, in terms of sort of like structuring things better, so we see the introduction of ESG, environmental, social and governance aspects coming into deals a lot more. And I think that is really good, because it means that there's a better scrutiny. And then also the sector's won because of, and we'll talk about probably this a bit later, the documentation, all this chucking of paper around like we're doing here today, it's gone to electronic. A lot of it's gone to electronic, and that cannot be a bad thing because in the electronic process, you've got a much more secure platform. So you've got sort of like a winner in that sense as well. Some of the insurance companies sort of exited as well because they got burnt or they've had to fork, not necessarily burnt, but they all say they got burnt. But you won't hear this from them. They've exited or they pulled out to more profitable areas. They've just moved business. And then the other big raft of winners, of course, are the smaller banks that have taken up financing, commodity trade finance, and not just the smaller banks, the localized banks in particular markets that will just do what we're just going to do this particular country or this particular region, but then also the funds that have come in and they've picked up one heck of a lot of business. And we've just seen that, the growth of the funds, whatever they might be, a hedge fund, family fund or capital management fund. And that is a real significant boost to the sector.
And I guess that's probably plugging the gap for some of the quote-unquote losers, some of the mid-market or smaller producers and traders who aren't able to receive the historic bank capital they could.
Exactly. That's filled the gap. And there's always been a trade finance gap or a commodity trade finance gap where people haven't been banked. That's an exciting thing, and so these players, and a lot of them are below the radar. They'd like to stay below the radar and they won't talk about their business or what they're doing, but they're there, they're operating. And sometimes we know there's collaboration between mainstream banks and some of these funds because they can take up a parcel of that particular business. And of course, the other really, really big winner, and we'll get to talking about this a bit later, I guess, are the big commodity traders because they just have got bigger and that's phenomenal.
Very interesting. I guess let's talk about the trade finance structures that you alluded to earlier. And I know TXF has done a lot of research on the underlying structures because I think they've seen a bit bit of a shift over the past decade, because even though unsecured finance represents around 3/4 of commodity trade finance volume, secured debt is what's really seen a bit of an uptick in the past couple of years. What's happening, and is this due to a fight to quality for structured commodity finance?
That's what the banks will say. It's a flight to quality. I actually detest the term, because the flight to quality, I mean, what is quality? Some of the big clients, just because they're big, might not be quality. You just have to look below the surface and you find it just depends. But they'll call it a flight to quality, and there's no going back from that. A lot of the banks are just doing key clients. Again, it comes back to smaller traders and smaller producers aren't necessarily getting a look in. So then where are they getting the money from, those people? So you think that big commodity traders, which don't have a problem in accessing funds. In fact, we're seeing them having increased funds. They get increased funds, and they in turn will lend to smaller traders and producers. So they will actually create the deals, bring them back to certain banks, so there's a little element of we're taking some risk. We've got some skin in the game. There is some sort of thought, that commodity finance is overall declining, and it probably is. But at the same time, there's a lot more going through the big trading companies than there ever was before. If you look at the sort of finance which they're raising now, and if I may, I could probably just sort of talk about how they're actually raising their funding, and they're changing. Some of them are changing in sort of like different ways to access sort of funds that they wouldn't normally have accessed in the past. And if you look at Olam, for instance, Olam Agri, which is a big agri-trading company based out of Singapore. I think early April, they did a financing which was 680 million or so. And it was a Murabaha finance, Sharia compliant transaction. That was with investors out of the UAE, Malaysia, Hong Kong, and Singapore, bringing in people that hadn't necessarily been there before. And similarly, we saw in March, isn't necessarily new, a samurai loan to Trafigura. And samurai loans aren't anything necessarily new, but it's new in the sense that every time they do it, newer investors come in. I can't remember the figure actually, but in March it was big anyway. It was probably about 821 million. And of course, there were 24 lenders on that, mostly Japanese, or maybe all Japanese, but significantly, I think there are probably 6 or 8 new lenders in that, and they will be investors that know that this is good, bankable business. The big trading companies know where to go and to change their financing modus operandi. And that's what makes them so unique and cool.
It's building a market for sure. I mean, do you think that the commodity trade finance market is actually growing, but actually there is a changing role of the banks within this?
Yeah, the banks, as we've already mentioned, they've stepped back. Their role has changed. So they've become, if we're talking about mainstream banks anyway, they're still doing a great job. I mean, if I look back to, say, before the pandemic, when there was some fantastic deals being done in, say, China, we don't see that now. And I know there was some problems with the Chinese smelters and things. I don't think it's really right for me to go into some of the details of that, because I know probably too much and I don't want to get shot. There are things that could have been done better, but I think that basically it was good business. Overall, if we're doing sort of structured commodity finance business and you've got the right things in place, those deals are really not going to go wrong. A structured commodity finance transaction rarely goes wrong. So we're seeing a lot more deals now, where they're going to be sort of pre-export finance, pre-finance, borrowing-based loans and the like, and reserve-based transactions. If you have those deals and you have everything in place, or you've got a structured commodity finance where you're putting more covenants on, and more structures for people, then it just secures it down. So I think we've lost an awful lot of good structured commodity finance bankers. And I think the banks have done themselves a misservice by sort of getting rid of some of those people. Bank boards haven't necessarily been as smart as they could be. They need to listen to the guys that go and do it. The one good thing about commodity finance and structured commodity finance is they actually know the business. They actually know it. There used to be a stage where you'd see institutional banks come in, and I won't mention any names, but they'd come in when the market was sort of like buoyant and everything. They'd come in and they'd chuck a load of money at deals, but they didn't know the business. But the structured commodity finances would actually know the business. They'd actually go to a site to see where that metal is being produced, actually see the ingots being churned out, or the oil being pumped or whatever. They got their hands dirty. They went and sat up in the shitty hotel in Norilsk, in the hotel room where the water runs brown out of the taps and stuff. They knew their stuff. And you have to go and see your clients. You have to go and see things being produced. Otherwise, you're working in the dark. I think there's a realism which needs to take place in all areas of banking. And the people that sit in compliance just don't realise that. People that sit on bank boards don't necessarily realise that unless they've done this themselves. But there's a lot of smart bankers out there, and there's a lot of smart financiers in other areas for commodity finance.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. Jonathan, you talked about China and pre-pandemic deals, and I guess that segues quite nicely onto the question around fragmentation and this real changing political order, which is completely changing trade routes. And even if it's incremental and slow, you fast forward 5 years, 10 years, and suddenly China, Turkey, Russia have very different roles in world order. And I think you've really seen some shift in supply chains. You've seen this rising phenomenon of ghost traders. Can you elaborate on the effects of this fragmentation and changing of political order and supply chains?
The whole issue of China is absolutely fascinating because, China has always been the big buyer of everything. Even though it produces tons of raw materials and commodities itself, it's been the big buyer because it's the powerhouse, isn't it? So it sucks in all this stuff, whether it's from Brazil, whether it's from Australia or from Russia or wherever. It's absolutely fascinating. And unfortunately, the real fragmentation that's taken place is because, for a start, it's, the US and China and the locking of horns, and it's economically and it's politically and it's militarily and technologically. And they're vying for the top spot on all of this kind of stuff. So it's very, very difficult and tetchy. And of course, in the Trump years, we saw the sort of like raft of trade wars taking place, and some further fragmentation of all that, and various sort of like sanctions for all kinds of things. China is still this sort of like this huge powerhouse that remains there. And China in recent years has fallen out with Australia, but it's gone now back to sort of like to buying coal from and iron ore from Australia. But the other thing that comes in on this whole fragmentation thing is the fact that Russia just screwed the world up by invading Ukraine in February 22. That has been disastrous. It's absolutely disastrous for everybody. And China is making a killing out of it. India's making a killing out of it. Turkey's making a killing out of it. And then get on to the others in a minute. So they're making a killing because of the fact that oil and gas is going to those countries. And of course, it's been sold for peanuts, well, not peanuts, but huge discount. And then other things are going through, particularly India, and moving on into other markets where it goes, So if you've got a diesel car, then you're still putting diesel in it. It's from Russian crude, and it's come in a circuitous route to come back here. But this fragmentation that has taken place through all of that has led to sort of other things where you've got sort of like very, very dark side of trading where it's actually sort of sanctioned goods, where it's going out. And so there are some rogue traders that you might call them that are actually sort of like taking shipments, and you've got these rogue vessels, which are just sort of ghost vessels, if you like, these sort of really dodgy tankers, which can just about remain floating. There's this other side to it, but, Russia doesn't care. The rest of the world does. And then the whole problem about this with the fact that India doesn't really care because it's really won an awful lot, and it's getting a lot of business into Russia accordingly. Similarly with China, and it's creating this sort of like this sort of almost two worlds. Very, very difficult for everybody to deal with, and the implications are still there. And I think it's just got a lot worse actually because of the past weekend when the US has implemented some further sanctions on Russian metals. And Russia is just this huge producer of many commodities that we want. You name it, it goes across the board, whether it's from aluminium to nickel to gold to potash to fish. It's got everything. And we saw it at the beginning of the war when it moved into Ukraine and stole from the places where there were silos, it just took the grain, and then there was really big problems in sub-Saharan Africa, North Africa and the Middle East, where that grain would have normally gone, and the winner, of course, again, is Russia, because Russia can then sell that and sell its own, as with Kazakh as well. So you have problems like this, and these aren't going away. I think they're just going to sort of like get worse, and we would all like, an end to this. But of course, this is Putin's war, and I make no bones about it. It's disastrous. And all the time in commodity finance, when something goes wrong, there's people out there that will love it, because it's, and other people think that, yeah, we quite like it, but actually this is too bad. And it is really too bad. And it's a shame that some of the southern countries or the emerging markets aren't actually calling it out, but they've got a vested interest not to call it out for many reasons.
Obviously, you're now seeing a hugely increased sanctions regime amidst the global conflicts, and we can continue on this. How are the commodity trade and transportation routes being reshaped, and also how should participants of commodity trade finance actually kind of navigate around this landscape to ensure deal security amidst all of these disruptions?
Yeah, thank you for getting back onto that. Because, I mean, there are, again, winners and losers in this, and the trade patterns that are changing with all the things that have taken place. Of course, Western Europe got really totally kicked because of the energy problem. So prices skyrocketed after Russia invaded Ukraine, and they've gone back to a little bit of sort of normality at the moment, even though Brent's at, $90 or something, and Western Intermediate crude is probably just under that. The gas that would have gone into Western Europe's got to come from somewhere, and the winners on that, the big winner on that, of course, is the USA, which is now sort of like shipping loads of LNG across from the Gulf, Mexico, into Western Europe. Poland was probably the first really big customer there, but others are taking more, will continue to take more. Oman is shipping quite a bit. But then again, where on the softs front, other winners were really countries like Argentina, Brazil, Canada, USA, that were moving soft commodities into those markets, which were experiencing problems. So you've got all this kind of stuff. But then with some of the global problems we're seeing this, we saw it in the pandemic, but that was due to sort of like the Ever Given getting stuck in the canal. But now we've got, the Houthi rebels and all the problems that we've got, with the Suez Canal. And so we've got vessels now going around, South Africa and right the way around the African coast to come back up to Europe or to go across to the States. And they're going that way because like the Panama Canal is a bit messed up because of the drought, so there's limited volumes of traffic going through the Panama Canal. And if they're going through, it's really expensive. So they're coming the other way. And the cost of going round rather than coming through the Suez Canal is, exponentially greater. We saw a lot of this in the pandemic, largely because containers were in different places. Now it's just sort of like logistical problems related to geopolitics mainly and conflicts. We're sort of also seeing, the fact that a lot of commodities are actually containerized now rather than being carried in bulk carriers. And if you look at, say, the sugar business, so much of that is done now in containers. So you've got the problems with, and the exponential cost has increased, dramatically. And I think it will continue to. Some of the big trading companies have their own shipping lines, and they're pretty much okay, but they're looking to invest further. And one of the good things about that is they're also moving quite a bit of their shipping through to sort of more environmentally friendly fuels. So that's a good sign in shipping because it's really needed because it's a dirty business at the moment, still shipping. And so we're seeing more environmentally friendly activity on that front.
Absolutely. Let's talk about electrification and EVs, and you'll see just outside there we have the TFG e-bike, which is very heavy and largely because of metals like copper, nickel, lithium, zinc, and some of the critical metals, germanium and rare earths. How are commodity traders planning to address some of these changing market needs so that the EV drivers, etc., can power that? And I guess another question, how are governments and ECA supporting these supply chains, securing supplies?
It's a really good point. I mean, electrification is just massive. The energy transition is massive. And the bulk of the big trading companies have got their fingers right on it. I mean, if we just sort of like step back a bit and I'll say something which is like controversial, there's a lot of oil and gas being financed. And of course, it's going to be financed for decades to come because we're going to need it in everything. So like 30, 40, 50 years' time, we're going to need oil, sort of hydrocarbons to produce plastics and things. This is going to continue. Some of the bankers pretend that they're not financing oil, but I mean, they are financing it, but a lot of them have stepped back from sort of financing coal because it seemed to be sort of like really dirty. That's been picked up by specialized traders. But the electrification process and energy transition is really about these fundamental metals, which we've been talking about for years. The big traders and all the traders are completely on top of this. They know everything that's going on. And if you listen to a traders, and we'll hear more about this in Amsterdam conference, the predictions are by the end of this decade, we're going to be sort of like short of copper. And copper is going to be needed, not just in sort of electric cars and every other bit of electronics, but it's going to be needed, massively in cabling with the transmission of electricity. But we're going to be short by about 4 million to 5 million tons by the end of the decade. So analysts predict. But even this year, we're at about $9,500 for a ton of copper, and people predict that should be about $10,000 by the end of this year. So there's a lot of concentration on what is termed in the market as Dr. Copper because it is a sort of like the bellwether mineral metal that people will look to. But then it's the range of metals and minerals well beyond that. And we've got, as you've mentioned, the various other specialized metal, in particular sort of like things like aluminium, nickel and niobium and all the rest of them, and even down to the rare earths. So you've got all those kind of things. Now, the other part of the question was, what are the traders doing about this, or what are governments doing about this as well? They're doing quite a lot, and we've seen, and it isn't just something recent, particularly when you look at, say, export credit agencies such as Japan's JBIC, Korea's KEXIM, and others. They've been on China Exim, for instance, as well. They've been on this platform push for some time, but we've seen others come in now. We've seen Euler Hermes of Germany come in. These are all working with traders or producers or industrialists of one sort or another. I think EDC from Canada and then EFA from Australia have also been active. And a lot of that has been with energy, but some with metals. And in one particular one, which was a deal of the year, not this year, but last year with TXF, was an 800 million financing for Trafigura, which was for non-ferrous metals, for Trafigura to bring that into German industry. So Euler Hermes provided the finance. This was a sort of like, a particularly big thing for the market, because I would go to sort of like to Trafigura and say, well, what sort of metals is this? And they would just say, well, it's non-ferrous metals, and it's like, yeah. But we know that it's going to be copper, and it's probably cobalt as well. But at the same time, we're seeing sort of investment by developmental banks, on various things. So it's not just export credit agencies. And I think Trade Development Bank of Southern Africa provided financing to Trafigura for a copper cobalt. It was like 600 million back in 22. That was for a copper cobalt mine, which is pretty significant. They don't like to talk about it because it's in the DRC, Democratic Republic of Congo, where, there's lots of issues. But these are things which are just needed. And then there was another interesting, but it's in principle loan of up to 800 million from Euler Hermes of Germany with Arafura, which is a rare earths metals producer on the Nolans project in Australia. And that would be metal that would come back into Germany once it's been produced. You've got all these sort of things happening, and these are all done with traders and export credit agencies. So it's a really good alliance. But the traders have got their finger on the pulse, and they know what's going on.
It's interesting. It's probably been led by national, regional interests. And I think, national interest in the country's security is one of the reasons why that involvement's happening. What does this actually mean for international commodity trading companies, and what is their role, whether it's big or small, in the future of commodity trade finance?
The commodity traders are king, just absolute king in this field, and they're running the show. I mean, the fact is that, big commodity trading companies can go to a particular country. They'll go down to the Australian Wheat Board, and they'll tell them what they're going to buy their wheat for per tonne. They can control the market. I won't mention any, but we all know the names, it's the ABCDs. They will go down there and they will tell them, we're going to buy this and we're going to take this and move it out, So there's a big control there. It's not surprising that whatever commodity it is, whether it's going to be sort of oil or whether it's going to be grains or something, they're making so much profit through these years. People will look at companies that make huge profit and say, oh, well, they should be paying some kind of extra tax or whatever. Well, okay, maybe they should. I'm not going to get into that. It's a big political argument, But you saw Vitol, Vitol, which is an energy trader. And I think in 23, they made $13 billion profit. Trafigura made $7.4 billion profit in 2023. Good for them. The shareholders, the directors, are doing very well. And so they're both very well run companies. This is the nature of business. They're very successful at it. They know it very well. And as we've already spoken about, they do help smaller traders, smaller producers. And if you look at some of the deals which are being done, even if we just go back to something that we probably should have talked about a little bit earlier, the fact that one of the deals which we will be awarding in Amsterdam is a deal with a metals trader, an IXM. This was a revolving credit facility, but the great thing about it was that it has ESG compliant facilities within it. So meaning that the loan will get cheaper if they put into place various environmental or social or governance aspects. So the loan gets cheaper. So with this sort of stuff, and that was like a 783 or 2 million transaction was done last year sometime. These are sort of landmark deals in the sector because you could go back, sort of like before the pandemic. You didn't have these sort of like ESG things with revolving credit facilities, but to put them into place with the traders is really good. It's really good for the world. A lot of things are being done which are quite unique in that respect. But the commodity traders know what they're doing, and I think it's good for the sector.
All of this plus much more. Jonathan Bell, we're so lucky to have you on Trade Finance Talks. We can't wait to find out more and hear more at your 10-year anniversary, which we're really proud to be media partners of at the Global Commodity Finance Conference in Amsterdam. As I said at the start of the show, 22nd to 23rd of May 2024. Final question, what are you most excited about for TXF Commodities Amsterdam?
I think I've already mentioned I like a lot of the people there. So I'm meeting old friends, meeting new people. The great thing about the commodity crowd is they're can-do people. They will go out there and they'll overcome a problem. If there's an issue, even if the deal's going and there's an issue, they'll overcome it. They'll find a way to deal with it. Or if they see a deal, think, heavy, isn't it? But they'll work around it. They'll find a way. So they've got a sort of can-do attitude. And I really like that. When we did the first conference we ever did after the pandemic was in September 21. And, we hadn't been at a conference for a year. It was in Geneva. It was a commodity conference. And everybody was so pleased to see each other. We were all sort of hugging each other. We'd gone into the hotel, we chucked off the masks and we were hugging each other, So there's a really nice vibe about it. So I'm particularly excited about seeing lots of really good friends and meeting lots of other good people. The great thing is that there's going to be a lot of really good chat and talk about the business as it is, and what we can do going forward, how we can make the world better and how we can make financing a lot easier on everybody, how we can sort of get out of some of the things that we've been problematic in the past. And I think that there's going to be a lot of really sort of good discussions on some of those areas that we've discussed and some of the new areas, looking forward to the future. So I'm really excited about it. I'm very much looking forward to it.
Well, here's to the next 10 years. Jonathan Bell, thank you for joining us on Trade Finance Talks and see you in Amsterdam.
Yeah, see you in Amsterdam, Deepesh, and thank you very much for inviting me here. It's been a pleasure.